We've all heard it, right? You've got to invest for your future. But let's be real. Trying to figure out which individual stocks to buy can feel like a total maze. It's so overwhelming that a lot of people just don't do it. But what if there was a much, much simpler way to get started? And that's the big fear, isn't it? The worry that you'll pick the next big flop and lose all your hard-earned money? Well, that exact worry is why investment funds were created. And trust me, the concept behind them is probably way simpler than you think. So here's what we're going to cover in this explainer. First, we'll get into the big idea behind what an investment fund even is. Then we're going to break down the 4 main types you always hear about. And finally, we'll talk about how you can figure out which one might be right for you. All right, let's dive into part 1. You hear all these different names thrown around: mutual fund, index fund, ETF. But you know what? At their heart, they all share one simple, really powerful idea. Okay, check out this snack analogy. It's actually perfect. Imagine you've got $2, enough for just one snack. But you're kind of nervous. What if you pick a bad one? So you get 3 friends to each chip in their $2. All of a sudden, you've got $8. Now you can buy all 4 snacks on the shelf and share. You get to try a bit of everything, and if one of them is gross, who cares? You've still got 3 others. That's it. That's the basic logic of a fund. So that's really the core concept right there. An investment fund is just a giant pool of money. Your cash, my cash, thousands of other people's cash, all gets collected together. And that big pile of money is then used to buy a whole bunch of different things: stocks, bonds, you name it. And just like that, everyone who pitched in gets instant variety, or what the pros call diversification. Let's make this real with a quick example. Let's say there's a fund called the Big Tech Fund, and it only invests in 5 massive companies, putting an equal 20% chunk in each. If you put just $5 into this fund, boom, your money is instantly spread across all 5 of those giants. $1 of your money goes to Apple, 1 to Microsoft, and so on. With a single click, you own a tiny piece of 5 different companies. Pretty cool, right? And 5 stocks is just the beginning. This is where the power of funds gets kind of crazy. Some funds out there, like Vanguard's Total Stock Market ETF, hold shares in over 3,600 different companies. Just think about that for a second. With one single purchase, you can own a sliver of pretty much the entire US stock market. All right, so now that we get the basic idea of pooling money, let's get into part 2 and break down those 4 most common types of funds you'll run into and what actually makes each one different. First up, we've got the classic, the original, the mutual fund. Think of this as a professionally managed fund. There's a fund manager, a real person, whose job it is to actively buy and sell things to try and make the fund grow. Now, the key thing to remember about mutual funds is they only trade once a day, after the stock market closes, at a price that's called the net asset value, or NAV. Now, because most of these are actively managed, meaning that Pro is making moves all the time, they cost more. They have higher fees, which are called an expense ratio. And we're talking anywhere from 0.5% to 1.5% of your money every single year. They also tend to have higher minimum investments, often a few $1,000s just to get in the door, which can be a barrier for new investors. Next up is the index fund. And this one has a completely different goal. An index fund isn't trying to beat the market, it's just trying to be the market. And how does it do that? Simple. It just buys and holds all the stocks that are in a specific list or index, like the famous S&P 500. Because it just follows a recipe, it's called passively managed. So there's no high-paid manager making brilliant stock picks here. The fund is basically on autopilot, just following the index. If a company gets added to the S&P 500, the fund buys it. If a company gets kicked out, the fund sells it. It's that simple. And because of this hands-off approach, the fees are incredibly low. Also, and this is important, you can find index funds in 2 flavors, as a mutual fund or as an ETF. And that is a perfect segue to our third type, the ETF, which stands for Exchange Traded Fund. This one has been a total game changer for regular investors. An ETF is a fund, same as the others, but here's the magic trick. It trades on a stock exchange all day long, just like a share of Tesla or Google. And this is why ETFs have become so incredibly popular. Most of them are passively managed, which means they have those super low fees just like index funds. And since you can buy just a single share, your minimum investment is just whatever that one share costs. Could be $50, could be a couple hundred. That mix of flexibility, low cost, and easy access is a winning combo, especially for beginners. And finally, let's talk about the most exclusive club in the investment world, the hedge fund.
You can almost think of a hedge fund as a mutual fund on steroids, but only for the super rich. These are private operations, not open to you and me. They're famous for being super aggressive, using really complex strategies, and taking on huge risks, all in the hope of hitting absolute home runs.
And yeah, their exclusivity is no joke. The price of admission, minimum investments usually start at $100,000 and can easily go into the millions. They are actively and aggressively managed, so you better believe their fees are the highest of the bunch. For all practical purposes, these are in a totally different universe from what most of us will ever invest in. Okay, I know that was a fire hose of information, so this little summary table pulls it all together for you. It lines up our 4 fund types across all those key things we just talked about. Honestly, this is a great slide to hit pause and take a quick screenshot of for a handy cheat sheet later. So, for our last section, let's put it all into practice. Now that we know what these things are, how on earth do you choose the right one? Well, it really boils down to what's most important to you and your own financial goals. First off, let's think about convenience. If you're the kind of person who wants the freedom to buy or sell at any moment the market is open, ETFs are the clear winner. But if you're more of a set-it-and-forget-it investor and you don't want to be tempted to watch the price all day, that once-a-day trading of a mutual fund might actually be a good thing for your peace of mind. Next up, and you guys, this is a really, really big deal, fees. An actively managed fund could be charging you 1.5% a year. A passive one might charge just 0.05%. Now, that difference might sound like pocket change, but over decades, those higher fees will devour a shocking amount of your money. Lower fees mean more of your returns stay in your pocket, working for you. But okay, that leads us to the million-dollar question, doesn't it? We'd be happy to pay higher fees for a genius manager if they get us better results. So when you look at the data, which type of fund actually performs the best over the long haul? And here it is. This is the punchline. And for a lot of people, it's a real shocker. Over and over again, the data shows that in the long run, those simple, boring, low-cost index funds and ETFs often end up beating the expensive, actively managed funds run by the Wall Street pros. Wait a minute. What? How can just buying a list of stocks beat an expert who gets paid a fortune to find winners? I know, it sounds completely backward, but there's actually a very logical reason it happens. It really comes down to 2 simple things. First, consistently outsmarting the entire stock market year in and year out is just insanely hard. Even the smartest people in the world struggle to do it. And second, like we just saw, those higher fees are like running a race with a parachute strapped to your back. The active fund has to beat the market by a huge margin just to cover its own costs. Over time, that becomes an almost impossible hurdle to clear. So that leaves us with a final, kind of provocative thought. For a long, long time, smart investing meant finding that one genius manager who could beat everybody else. But what if all the evidence is telling us that the truly smart move is just to own the whole market at the lowest possible cost and just let slow and steady win the race? It's definitely something worth thinking about.